rarely seen where a new product has completely destroyed, well, not completely destroyed, but very much hurt the bread and butter revenue line of the old product. The stock has never been cheaper in relation to its peers, the wider market itself, its EV divided by EBITDA. I could hit you with numbers like a machine gun, but the reality is with
I am about to get blindsided, not physically, but by my friend across the screen from me, Emmet Savage, co-founder and chief investment officer of MyWallSt. He has a stock idea that he has not told me about. He has not at all given me any information. He's going to present it, and I get to ask questions. MyWallSt, actually, Emmet, let's go to you first. So I've known you for a little while now. Let me ask a few lightning round questions, if you don't mind, before we unpack what MyWallSt is, and then get to your stock idea.
I'd be delighted, James. Okay, you hit me.
Okay, so most influential person, non-family member as a kid.
Brian May, the guitarist of Queen.
Interesting. Why was he influential?
Well, I had a specific affiliation with their music. I just thought it was wonderful and bigger and bolder than most other musicians. And I'm a guitarist, so he was my guitar hero. So I guess if we remove friends and family, the riffs that I was trying to learn as a kid were Brian May's riffs.
Most influential non-investing book.
That's a tricky one. The one book that stuck in my mind, and I never reread it, but it had an outsized impact on me at the time. And again, I was probably only 13 or 14 when I read it, was by a Scottish author called Ian Banks. And the book is called The Wasp Factory, which is a book that's not unlike Lord of the Flies, but has a more modern twist. And Ian Banks wrote some wonderful novels that always had a twist in the tale, and it was the first of its kind that I read, and that certainly is one that jumps to mind. Although there's a lot of different books that I love along the way. Anything by Bill Bryson for a start. If I was just left alone with all his books, I'd be very happy.
Are you first on the dance floor or a dance floor avoider?
Well, generally Irish males avoid a dance floor like the plague. And I don't even know if that's just an international thing, but at weddings, generally speaking, the females drag the males onto the floor. When I was a younger man, I wouldn't say first up, but I didn't need a whole lot of encouragement. Now I'm like, oh, please save me. I got to get out of here. I'm looking for an exit.
I am too. In college, I took an anthropology class, and the book we were reading was called Saints, Scholars, and Schizophrenics. And it was about this Irish avoidance of things like that, sort of carnal pleasures, dancing, fun. Yeah, it was pretty interesting, actually.
Yeah, that's so true, though. It's culturally there. There's no doubt about it.
Last stock you bought, last share you bought, if you remember it.
Oh, sure. The last share I bought, was it either Dino Polska in the Polish Stock Exchange, or let me think. No, Kinsale Capital was the last stock I bought.
Yeah, actually, I bought that one too.
Oh, interesting. There you go.
Yeah, they're not far from me here in Virginia. About 2 hours.
Right. Wonderful business. Wonderful business.
So in 30 seconds, can you explain MyWallSt to somebody just watching us and hearing this for the first time?
Sure. Well, MyWallSt's mission is to get the world investing successfully. And I co-founded it here in Ireland 10 years ago. And the first people I went to meet, I'm a physicist. Like the real me is a complete fake. Like I've just loved stock investing for my entire life. So I never came through the normal path, the financial path and financial school. I did the physical sciences right through, but I flew out to Alexandria, Virginia. I met the co-founders of the Motley Fool. They knew me as an active member of their community for a very, very long time, I think from the very start. And I pitched an embarrassing pitch on what I was out to achieve. I can actually make my face go red when I contemplate what it was I was saying to them. I said, guys, I'm going to get 1 billion successful investors. 1 in 7 people. So I was thinking big. I've always thought big. So MyWallSt is a suite of products that educate the masses on how to invest in the stock market. And I think more pertinently now, advise people on what stocks to buy. And I have a 28-year compounded annual growth rate of 22.7%, which is good.
That's amazing.
Well, it's not bad, but I really got obsessed in what are the characteristics that Dell had on the first day of 1999 that are common to businesses now, because Dell grew 1,700 fold in the 10 years that were the 1990s. And I just got obsessed with finding the next Dell. And that led me on to, I guess, investing in Netflix 22 years ago and Tesla 15 years ago. And I guess I've had some big winners, but I've had a hell of a lot of losers. So my Wall Street's mission is to get the world investing successfully. About 12 million people have our app on their phone to either learn or get stock advice. And we have a suite of wonderful products designed for any person to outperform the stock market.
I'm still trying to get that 22.5% stat out of my head. It's all I can think about. So let me go now to tap some of that. The market itself, for somebody just like plugging in and wondering why is that great? The US market, at least, and your products, I understand, largely overlap so if you're in the US, you could make full use of MyWallSt's products. It has a lot of American market stocks. The American market has risen, 9 or 10% per year on average historically over the past 100 or so years. And Warren Buffett himself has averaged something like 19% or 20% per year over his investing tenure. A lot of that came in the beginning. So 22.5% is, yes, the time period is shorter, but it's technically better than Warren Buffett's return. So that's an excellent return. And it makes me all the more excited to ask you, what is this new share on your radar now?
Well, James, there's a lot of quality companies on sale out there at the moment, in my opinion, because we know general media has been talking about the Magnificent Seven for I don't know how long, maybe 3 years, 4 years, 5 years. I don't even track that. And then the other 493 or the S&P 493 have been in large part ignored and dumped. So I think there's a lot of quality companies on sale right now from various exchanges around the world that have caught my eye and have passed multiple tests that we run here at MyWallSt, and the very same tests that have resulted in my 28-year compounded growth rate that we spoke about. And the only thing you said to me in our email exchange was, look, let's just, what do they call it when you're in the airplane and you don't even look at phones, like raw dogging it? We're like, let's just go for it. Just hit me up. Just tell me this. Don't even tell me the name of the stock. Just can we keep it American? And you're absolutely right. 95% of everything I've ever bought is listed on the two big US stock exchanges. So I'm keeping it American today. And I hope what I'm about to say to you is not dreadfully unoriginal, but I think it is a really great opportunity at the moment in plain sight that most people would look and shrug their shoulders. And it's a company, I'm sure you know, it's called Paycom. Do you know Paycom?
Paycom. P-A-Y-C, is that the ticker?
That is its ticker, PAYCOM. It's a software company that specializes
Yep.
You know it. They specialize in payroll and HR stuff, human capital management solutions. So if you work in a medium or large size business, as most of us have learned, there is a process for interacting with your employer. And Paycom have focused on small to medium sized businesses. And it's seen a lot of success in moving upstream to larger enterprises in recent years. But the reason I believe this stock is particularly interesting right now is that it has cannibalized itself, which is something I've rarely seen, where a new product has completely destroyed, well, not completely destroyed, but very much hurt the bread and butter revenue line of the old product. And as a consequence, the stock was truly hammered, but I think it's misunderstood at the moment. And I might give you a TLD or a top line don't read on Paycom. Will I give you just a couple of stats before we dive into it?
Sure, sounds good. And by cannibalizing itself, you mean like buybacks? Is that?
No, actually, sorry, that's the general meaning. But what I mean is that they had a product that was generating magnificent revenue, and they released a new improved product, and it was so good that the customer base
which is a tough thing to do for many entrenched companies. So that sounds great already. It shows management discipline. So yeah, why don't you take us kind of top line down into Paycom a little bit deeper, and then I'll start asking questions.
Right, let's do that. Well, just for our listeners' sake, as you know, or as you said, its ticker is PAYC. Its market cap, which as we all know is the number of outstanding shares multiplied by the share price, is about $10 billion. So if we wanted to buy this business in its entirety, we got to pass around the cap and get $10 billion plus some extra, because these things always spike. At its peak, around October 2021, the share price was about $550. Today, it's about $170. And it is a profitable business. But here's the 3 top line don't reads that I would hit someone with if I was in a long enough elevator ride. Number 1, the founder, Chad Richardson, is still at the helm as the CEO, and he's a bit of a superstar in the industry. He owns 12% of the company, which, as we know, aligns his interests with shareholders, which we can come back to when we dive in. Number 2, management has made a big gamble on this self-service product that I mentioned called Betty, Beti, which has significantly reduced payroll errors for its customers. Those very payroll errors were the things that the other product was actually making money on. But this has added, so this added accuracy has come at the cost of ancillary revenue. And I fully believe that this short-term pain will result in long-term gain. And then the third reason that I think this is a great investment is the stock has never been cheaper in relation to its peers, the wider market itself, its EV divided by EBITDA. Whatever number you look at, Paycom has never looked cheaper. And what we're looking at here is, will its gamble on its new product, Betty, pay off? And the customers are speaking, it certainly will. And it looks to me like a bargain. So there's my 3 top line don't reads.
Interesting. Yeah. In the US, I think that the TLDR, we say too long, don't read. So maybe it's a slightly different acronym on the other side of the Atlantic. Interesting.
Well, James,
yeah,
maybe I'm the village idiot. Maybe I just always thought top line don't read, but that probably too
or maybe
long
I'm
don't
the
read.
maybe I didn't look. Maybe I'm just assuming too much. It has crushed. I'm looking at a stock chart, Emmett. Let me just bring this up. I think I can share my screen as we're talking
great.
here. It has crushed the S&P 500, which I believe is this red line way down here at the bottom. It looks almost non-existent over the past, looks like what, nine years. So yeah, this 2021 was extremely high. Even with that big drop, it's still way ahead. So that's pretty exciting off the bat.
Well, it is.
And so what I was gonna say, in terms of like, you're a fundamental investor, and every fundamental investor knows there are these days too many data points. There's almost too much information for the most part. You got to decide what's relevant and what's not relevant. What are some of the things that you think the market is missing about this stock? Like, why is it so? Just because it's cheap relative to its high, and maybe more importantly, what are some major data points that you think are irrelevant in your reason for buying? What are you actually ignoring that other people might be weighing?
Okay, so on the first, I think what is a fact is that the revenue growth has decelerated because this Betty, which stands for Better Employee Transaction Interface, they released this product, and I don't even think the business realized it was going to be so good that would actually destroy the line items on their balance sheet of other products. So in Q3 of last year, the management shocked the market by admitting that Betty was, as I would say, cannibalizing its sales growth, and the stock fell 40% in one day, which we know that in the short term, the stock market is a voting machine, and in the long term is a weighing machine. And that instant knee-jerk reaction seemed a little overbaked to me at the time. Now, since its peak, it's fallen 70% because the world has basically looked at this new product and said, it's destroyed the business. But what it in fact has done is open another door. It gives more power to employees to conduct their own payroll. It's leading to fewer mistakes and overall more accurate operation. In fact, a recent survey from the company found that on average, organizations were able to reduce payroll corrections by 80% with this product, Betty.
Wow.
Yes. And the reason that is relevant is because those errors were how the other product was making money. So they've kind of figured a product that cures the issue that the other product was being sold to address. And before
Let's
this,
just double click on that image. So the other product was making money. So this one reduces the errors.
yes,
The other product was not reducing the errors somehow. Like, how was it making money? Was it
it
not
was
fixing the same
spotting
errors?
the errors. No, it was
Oh,
spotting
spotting, but
errors
not
where
fixing. I
this
see. Okay.
spots and fixes. So
Actually
before this Betty
fixes.
product
Got it.
came along, administrators were spending 8 hours per 100 employees reconciling errors in a pay period, which is a static number across most medium to large size businesses in the
Mhm.
US, that 8 hours per 100 employees is somebody figuring out they got a crayon on a piece of paper. There's someone in the back room going, I
Yeah.
think we might
Yeah.
have underpaid or overpaid this person. So along comes a solution for that problem. And this time they've reduced this problem. And the CEO founder, Chad Richardson, described it as a paradigm shift for the whole payroll industry, which sounds great. But the real reason that the stock went down so much is that, as we said, these errors were really the way Paycom was making money. And what they've done is taken a huge gamble with this product. They are saying, over the long run, we will earn customer evangelism, loyalty, higher net dollar retention, and ultimately boast some of the best retention rates in what's already a very competitive industry. And that foresight is now starting to shine through. So the second half of I think the first half of your question, James, is what's being misunderstood and what numbers do I not pay attention to? So if I can just, I suppose, tweak that a little bit. Well, when I look at a stock, you're right, there's no end of data now. And in the world, there's no end of data, but there's less and less knowledge, you might say. So it's like the internet, it's full
Mhm.
of information, but not a whole lot of knowledge. We all know if you Google something that's on your toe, you'll have yourself diagnosed as dying. The only one who has the knowledge is the doctor. So, but when I look at the numbers, when I look at Paycom, I'm going to tell you the numbers that are exciting me, and the one that, if you like, to a point I'm ignoring. So as you might have heard in the past, BCG and Morgan Stanley combined their energy and expertise to conduct the biggest study ever made on what is the ultimate driver of stock price performance over the long term. And the answer to that was very simple, like a high school, a first year in high school would know the answer. It's revenue growth. They took in more money than last year. Well, Paycom software has improved its revenue at a compounded annual growth rate for 10 years of 30%. And if you were to look at its
Mm.
growth, its revenue growth, it looks like a xylophone. Like every year it's not quite mathematically exponential, but it nearly is. So it just gets better and better and better.
Yeah, I
And here we
saw
go.
up 23% from 2022 to 2023 in this report I just saw. Yeah.
Precisely. So that number has me interested, not just because we all like to see revenue growth, but because it's been proven as the single number that most drives share price performance over the long term. So that's data point number one. Number two, the second number that kind of has me excited is kind of a little bit nerdy. It's enterprise value divided by EBITDA, and the enterprise,
Mhm.
by that measure, this stock has never been cheaper. So that has me quite interested. But the number that I am ignoring, or at least not paying too much credence to, believe it or not, is the share price, because those two numbers have told me enough to dig deeper into the business. And then when you pare back the layers and we go a little bit beyond the quantitative and start to look at the qualitative elements of the business, this is where we have an edge over the market. Uh, there's 1,001 tools that allow us to analyze the numbers of any publicly listed business or any equity or any asset out there. We can look at the numbers, but where we got to go a little deeper and where we have an edge as human beings is to think of human being things. And when I opened up at my top, too long, don't read. I mentioned that Chad Richardson is still at the helm as the CEO, and he, I said, is a bit of a superstar, and that's something that cannot be discounted. A founding CEO tends to make a far better leader of a business. And Purdue Carnot School of Management found that S&P 500 companies where the founder is still the CEO are more innovative, they generate 31% more patents. They create more valuable patents. They think different. Founding CEOs are not there to achieve next quarter or next year's targets. They're there to see their baby outlive them, become something far bigger than they are. I was at an event on Monday in the Irish Stock Exchange here in Dublin, known as Euronext Stock Exchange, and the head of Atlantic Growth Capital, a gentleman by the name of Martin Escobar, was there, and he said that entrepreneurs, successful entrepreneurs, and he, by the way, they backed Duolingo and DLocal, and they backed so many growth companies. Slack, for
They don't have
example,
money worries these days, I'm guessing.
they've no money worries, but they back. But he said the founders of all of these businesses have a very unusual characteristic. They all have had a trauma. Isn't that amazing? They all are dealing with a trauma. Entrepreneurs. Now, he said, I'm not here to judge people's trauma, but he went on to say it could be something as trivial as some guy or girl you rang when you were 13 never rang you back, through to something far more significant and weighty. But he said all of these, an entrepreneur is carrying a trauma. They think different, they act different, everything about their behavior is different. And if we bring it back to Paycom, it's still led by the guy who founded it so many years ago. I mean, the business was floated, if I recall correctly, the business was floated in 2014 on the New York Stock Exchange, but it was founded in something like 1998. This guy knows this business as a parent who has the privilege of raising their own child, knows their child. Like, this guy knows every.
And what is his trauma? What is this? Is he has a trauma? I'm guessing.
Well, no, to be fair, I don't know if he does or he doesn't, but I guess the reason I mentioned that point was that it shows the extent to which the founding CEO cares. They're working at a different. There's just a different set of
for different reasons too. You know, a lot trying to prove themselves from some deep-seated insecurity, something like that. Yeah.
Yeah, I mean that's exactly it. I mean, I'm a founder of a business, and my trauma is no more or less than the next guy's. But what I would say is exactly that. You're out to prove yourself to yourself. You are there to. You're actually there just to do something bigger than you would have ordinarily. And I just know that this guy, who I've watched and listened to in conference calls, has that founding CEO mindset. And I could sit here and tell you that the business is 20 times, it's trading at 20 times earning, and the stock is sitting at a third of its 5-year average valuation, and it's trading the S&P 500 multiple. I could hit you with numbers like a machine gun, but the reality is, with Paycom, we have a founder at the helm, and he said, no, while this business is really hurting, while this product is really hurting the rest of our business, when we cut to wide shot, we are going to dominate the industry. And as a consequence, what they're actually doing is they're really starting to hurt bigger players who are in the industry, the likes of ADP and Paychex, and they are going for it. They're winning new, bigger sized businesses where when they started out, even 3 years ago, they're looking at SMEs and slightly large. Now they're getting their foot in the door, bigger businesses, because the word is spreading. They're reducing costs and they're doing it effectively. And that's what makes a brilliant product. Find a boring niche business and dominate it.
And, I know from years ago, recommending, I think, ADP, maybe Paychex, some of these other payroll type companies, there's very high recurring revenue. And I flashed on the screen earlier, when you were talking about the growth rate, 90% year over year customer retention rate. That's easy to overlook for someone new to this space, even for MyWallSt, a subscription business. I mean, that's an amazing number. Retention rate is so important because it saves you a whole bunch of marketing expense and marketing headache. And it looks like I don't know what the peers are. Maybe they're 93%, but 90% feels very high to me.
It is. Net dollar retention rate, I think in the last few years, thanks to SaaS, has become a very fashionable number. And I think there was businesses being held up as poster children of what great net dollar retention rate looks like. And I think the highest I'd ever seen was Snowflake, which has taken a beating recently for a whole bunch of reasons that we don't need to dive into here. And its net dollar retention rate was touching like 130%. But I think, but what we're looking at here is a business that 9 out of 10 customers who were with you last year are still here. So all they got to do is just keep growing very slightly, and they're going to keep bettering themselves. So I think it is a really wonderful business. Now, what I would say to your listeners, James, is that this isn't a new innovation by any means. Like, this is not CRISPR therapeutics. Like, Paycom is not out to rid humankind of cancer. They do payroll software. It's not exciting. It's predictable. So it's not like, basically we're looking at a business that is very it's at a turning point. And if you go in and have a look at how even sometimes the eyes of a child will tell the truth. When you look at a stock and you go, is this going to turn, is this on its way up or down? Very often the simplest answer is right. And I think it looks like a business that has seen all of its bad news come out and is now turning a corner, and all of its numbers to me look very exciting, most especially how inexpensive it looks. But it's not, by the way, without risks. And I could tell you a little bit about those risks if you wish.
Sure, I want to ask the risks and what would make you sell this stock. But first is, I just was looking as we were speaking, I was looking on Yahoo Finance. It looks like insider ownership is not very high. Do I have that right? Or are there some like Class B shares that are not factored into the Yahoo feed? Should it be higher if it's still this guy's baby? And what sort of return, in another vein, should investors who are buying now expect? Like, is this going to double, is going to go back up, fivefold to where it was before? Is it like a 15% kind of modest market beater? Do you have any return bucket that you would put this share in?
So I can't speak to whether there's a separate class of shares, James, because simply I don't know. That's the truth. I don't know if they have a different class of shares. And but what I do know is that my approach to investing is, and insofar as I can do so, is never sell. So while I don't buy, I buy a stock with the anticipation of holding it for decades, which really means that no matter what I assimilate or look at now, it's going to become more negligible with every passing day. And I have stocks in my portfolio that I bought 30 years ago, and I'm very glad I did. In fact, all of the mistakes, I'd say 90% of every regret I have in stock investing is a consequence of a sell as opposed to a buy. So I really don't like selling. But to answer your question about the returns that we can expect from this, I believe the business has never generated more revenue than it did in the last quarter. The reason was the stock was hurt so badly was because the other line items from its other products were down. If we look at just good old fashioned PE, which is like investing 101, its PE has fallen from hundreds, 350 a couple of years ago, right down to about 20 P of around 20 now, which I know is still a little bit edgy if you're a conservative dividend or growth investor. But I am of the mind that this business, we're looking at a 3 to 5 bagger within the next 3 to 5 years based on models that I've run. But I tell you something else, James. My models have a remarkable common feature of always being wrong. I mean, I've modeled a lot of things
So
in
do
my
I.
life.
Don't feel alone.
So, I mean, I can tell you, I think it's going to be 3 to 5x in the next 3 so years. But as I said, as I say to people, I'm just going to buy it and give it 20 years, see what happens. And that's exactly what I'm going to do. In fact, Paycom is you asked me, you started the show by asking me what was my last stock purchase. Dino Poscan and Kinsale. Well, it's as good as certain. My next purchase will be Paycom. And I plan to hold it until I'm in my 70s, and I'm 49 today.
That is a very, very long time. Very impressive too. I did some cell analysis when I was at Motley Fool years ago. A bunch of us did, and the same thing. Like, we would have been better off not selling in so many cases. It's tempting to sell for a lot of reasons, but frankly, it's hard. Maybe if you're really, really good, and even Warren Buffett, regarded as the world's best stock picker, has said we would have been much better off had we never sold a share. Yeah. And so your attitude is probably better aligned than most people who have very clear selling criteria. So I think that's a good answer, I would say, on that to me.
And James, it's funny. The market will pitch you a reason to sell every day. like we are being
Yeah.
fed a steady stream of things to worry about. Like, and they're real things. They are real things. There's wars and battles going on around the world. There's supply chain issues coming from around the world. There's trade wars going, and there's this is what I'm going to do if I'm president. That's what I'm going to do if I'm president. Like, there's a constant narrative that would have you quaking in your boots. But the reality is that's just a steady state. If you just buy a business that you like and believe in, and sit on it forever, as per your analysis with the Motley Fool way back in the day, it's more than likely going to be a better strategy. It's less stressful, that's for sure. So in my mind, when I look at Paycom, the labels I stick on it are uh, boring. It is a bit boring, like, it's payroll software. Um, it is a known brand that's growing up. I wouldn't say it dominates its area, but it has, I would say, the highest level of respect in the area in which it's operating. It's predictable. It's not going to have a blowout kind of product that's going to change the world. But what I do like about it is that all the bad news seems to have come out about this business in recent times. And because of those recent times, because the world wanted AI, because the world wanted this next thing, I think it was over punished. I just think that this is a business that looks like it's just been thrown into the bargain basement with no regard for the fact that it really has a very strong, profitable business model.
Yeah, I mean, it sounds like everything you need for a long term winner. And as you're saying this, I'm thinking of that meme. It's almost a meme of S&P 500 stock chart going up over 100 years, and this was Great Depression,
Yes.
World War II,
Yes.
bombing of Pearl, this horrible, this horrible,
Yes.
this horrible, this, but then the thing just keeps going up, and you could have probably the same kind of chart on a stock by stock level for many stocks. Now, I will qualify that I think 60% of companies lose money and 40% of stocks go to zero.
Mm-hmm.
And so it is that S&P return is being driven by a relatively small number of really good winners. But if you've got a really good winner, even if you got a chance of a really good winner and you're a decent stock picker, it's better just to let that run. And it sounds like that's exactly the strategy you're espousing with Paycom. It's not a trade. It's not a catalyst based thing. Like, we're in for this reason, we're out for that
Mm-hmm.
reason.
Yeah.
It's
No,
something
it's
that we're in
not.
it for the long run. Is there a risk though, if you really love this founder CEO? I'm guessing if he started the company in 1998, he's not going to be there forever. What does succession look like? Is that a risk?
Oh, it is a risk. There's no question about it. And I would identify that as one of the greatest risks, because generally a great leader will have a successor, but they're broadly unknown to the rest of the world. They're not pushed in the spotlight. They might do it. Like, Tim Cook is a good example, where Steve Jobs was confidently introducing him on the run up before the world knew Steve Jobs was sick. Suddenly this guy, Tim Cook, was taking the microphone. And that's an example of succession planning done to the highest level. But no, we there's no rock solid succession plan visible with Paycom, as far as I know. Now, he's currently only in his early 50s, the CEO. So Chad Richardson is only I think he's about
Really?
52,
Oh, he was a young
53.
buck when he
He was
started this thing.
yeah, he was young. So it's not that we're looking at a 70, 80 something year old. But things change. Humans are mortal creatures. So yes, I would regard it as one of the top four risks, but I wouldn't put it as the number one risk. I think the number one risk is the reason the stock has been punished, which is decelerating growth. And like, the reality is, this Betty product has hurt the other product lines. But I think with the bigger picture, we've got ourselves a business that really has put themselves in pole position to win more market share. Another risk I think that exists, and we're seeing it all around us now, and it's no longer, sometimes when you identify a risk, you think, oh, once I have identified it, it's less likely to happen, which is a cognitive bias that's utterly crazy. But you're kind of like, oh, I know, I'm going to write down this risk, and if I wrote it down, they thought of it. But one of the main risks that I see in an awful lot of software-based businesses is security threats. I mean,
Mhm, mhm.
look, it's happening. So whether we're looking at the recent software giant CrowdStrike with the beating they took, or CrowdStrike, I mean, say Snowflake, which I mentioned earlier, they also had a breach of their database. A reputational damage can really hurt. And if the core of a business's engine is how it treats its own people and make sure the payroll is being done well and everybody's being treated and rewarded in the way that they've been promised. And that if that took a hit, I wouldn't be too excited or enamored about it. But equally, we all know businesses
But
cannot
you'd still
survive.
keep holding. Yep.
Oh, entirely. James, I'm going to get, this is going to sound like such a casual flex, so wait to hear how great I am. Believe me, this is not what I'm saying. But I was speaking with um, Chris Mayer recently, who's the author of a book, 100 Baggers and Where to Find Them. And, you know, I always get starstruck. I love talking to other investors, and Chris Mayer is one of the best. And I said, I can't believe I mean, you know, you've been on my podcast, Chris, and now we can ring each other. And I said, I've only 100 baggers in my folio. And he said, oh, by the way, you're the one who's the most 100 baggers I know. So I was like, me? But I can tell you, so I have my best performer is up 375 fold. If you go to my Twitter, which is my X profile, at Emmet, EMMETL Savage, I'll pin a tweet to the top there, which shows my over 100 baggers. So I have 8 over 100 baggers, but they all have one thing in common. I'm going to tell you what it is. Not one of them happened faster than 12 years. So like my average 100 bagger took 20 years to happen, right? So whether it was Tesla or Netflix, Chipotle or whatever, like that is a long time to wait. But they don't happen if you clip them when they're growing. You let your winners win and just forget about it. Just leave them there. So I'm buying Paycom, and it's with that knowledge, that lived experience, that I'm going to just leave Paycom there, buy it, set it, forget it. And if it doesn't work out, big deal. You know what? If you have a stock that goes up 375 fold, you can make 374 mistakes and you're still in the money.
I think it was Arizona State University professor Hank Bessenbinder who found that from 1926 to roughly present, a few years ago, only 4% of S&P 500 stocks contributed all the gains. The remaining 96% just collectively matched treasuries. And the only reason that can work is if those 4% are gaining a whole bunch mathematically. So this is exactly to your point, Emmett. If you clip those too early, like it's really stupid because you need those big winners to compensate. Like we're all venture capitalists. We don't realize it. We have that big histogram where a few big winners do almost all the lifting, almost all the rowing, whatever your analogy is. And so the dumbest thing to do is to sell them at some low gain. You're doing it right in my book.
It's so true. And you're dead right. I mean, and it's also reduces stress, it reduces taxes. You can just leave it there like planting a seed in your back garden.
So if somebody is watching this, listening to this, and says, this appeals to me, I like Emmet Savage, I like Paycom, I want more of this, where besides your Twitter, which we'll post on the screen when you mention that, where would you send that person?
Well, the first thing is listen to our podcast as well, because if they enjoy your podcast, I think they'll enjoy Stock Club, which is by MyWallSt. So listen to our podcast, Stock Club by MyWallSt. Other than that, if they want to go to mywallst.com, that's mywallst.com. We have a range of products there for any investor. We have one product which is like $100, and it's called Invest. And you will get a stock idea that's deeply researched every week that in the most times I would actually sell the farm to buy. So they could come from any exchange in the world. So if you want to have some great ideas and you want to drop $100, go to mywallst.com. But if you just want to hear more from me with guests as good as James Early on my podcast, which is called Stock Club, just go to all
better
your
than James Early.
No, James, not at all. Actually, yours was one of our most listened to and liked podcasts, would you believe? So thank you for that. And we have so it's Stock Club on MyWallSt. It's on all the podcast stores.
We will put both of those links up on the screen, Emmet. I will check out Paycom, and I'm guessing a number of other people will as well. You've been very generous with your time, with your knowledge, and just with your vibe. I think we need more vibe like this in the market. It makes not just better returns, but it makes the world a better place. Like when you're trying to find good companies and weeding out bad companies for the long run, like you're rewarding good companies, which is what makes an economy better. So kudos to you for that. And kudos to all those who are following this philosophy. Yes, I'm on a high horse saying that, but I really believe it. So thanks again, Emmet. And thanks to you guys, as always, for watching us at home.